In this video, I'm going to show you exactly how SEP IRAs work. Coming up next on Holy Schmidt.
Holy Schmidt!
Hi everyone, this is Jeff Schmidt with Deductions.tax and HolySchmidt.com, and welcome to another video. In this video, I'm going to show you exactly how SEP IRAs work. I'll cover off the vast financial benefits as well as the limitations of this plan. I'll cover off how much you can contribute and what your obligations are if you have employees. Also, stick around to the end and I'll show you how to correctly fill out IRS Form 5305-SEP, the only form needed for the IRS. And importantly, I'm going to show you which pitfalls you need to avoid when making employee elections on this form. And if you like the video, please give it a thumbs up. That tells YouTube that it's a good video and helps other people that are also interested in finding out how a SEP IRA works find this video. As always, if you have any questions, please ask them in the comment section below. I try to get back to everybody within 24 hours. Now let's get right into it. The Simplified Employee Pension, or SEP IRA, is one of the most popular pension plans for those who are self-employed. There are many reasons for this. First, it's simple and easy to use. SEP IRAs were designed to make things easy on small business. SEP stands for Simplified Employee Pension, and the primary idea is to keep things simple while still ensuring that people are getting the tax benefits of an employer-sponsored retirement plan effectively. In order to create a SEP IRA, the employer just needs to fill out one single form. That's the form I mentioned above. With a traditional 401k, the employer needs plan adoption agreements and specific addenda to incorporate newer pension laws and other forms. SEP IRAs also provide investment flexibilities that most 401ks don't offer. Next, a SEP IRA provides an easy way for you to save for retirement. If you're self-employed, you might not have many options for tax-advantaged retirement savings, but the SEP IRA is a great option. Next, contributions are tax-deferred. Your contributions are made with pre-tax dollars, so you receive a tax deduction today and only pay taxes when you withdraw the funds at some point in the future. The next benefit is contribution flexibility. The fact of the matter is you don't have to contribute every year for yourself or your employees. If you're having a bad year, then you just elect not to contribute that year or contribute less. And most importantly, you can make big contributions in your big profitable years. Contribution limits in a SEP IRA are much higher than a traditional IRA or Roth IRA, and significantly higher than a 401k as well. Of course, there are disadvantages to every choice in life. A SEP IRA is no different. If you have employees, they must be treated the same as you after they have qualified for the plan. This is an employer-only contribution plan. Employees don't make their own contributions, and you must contribute the same percentage of employee compensation as your own compensation. The other disadvantage is there is no catch-up contribution allowed for anyone 50 years or older. If you're over the age of 50, there are no catch-up contributions like you see in IRAs and 401ks. However, the higher contribution limits of a SEP IRA might outweigh this negative depending on how much you make. Next, there's no tax-free Roth-style withdrawal option. Those who prefer socking away money with after-tax contributions and enjoying tax-free withdrawals are out of luck. There is no Roth option, so while your money will grow tax-deferred, you will still be on the hook for taxes when you do take the distributions. Next, I'm taking you to the whiteboard to show you an easy way to calculate your contributions both for yourself and if you have employees that qualify for your employees as well. Here I am at the virtual whiteboard to discuss contribution limits. First, let me say that if you don't want to actually go through how to calculate SEP IRA contributions, you should skip ahead to what I think is one of the most important parts of this video, and that is how to fill out IRS Form 5305-SEP. The location of Form 5305-SEP on the video is shown above. As I mentioned earlier, a SEP IRA is one of the best investment plans for self-employed people to save for retirement because you can contribute a lot of money in good financial years and absolutely nothing at all in bad years. How much money can a self-employed person contribute? Well, the short answer is up to 25% of adjusted pre-tax compensation up to the IRS's annual limit for the year. In 2019, for example, the total limit was $56,000 and that was based on a pre-income tax base of $280,000. In 2020, the limit was raised to $57,000, and that was on a pre-tax income base of $285,000. There are some things to know. First, even though your contributions are income tax deferred, which means you pay income tax when you withdraw the funds from the plan, Uncle Sam is willing to wait for his income tax, and the states are too, but he is not willing to wait for his Social Security tax or Medicare tax. For self-employed people, Social Security tax and Medicare tax together is called self-employment tax. When calculating how much you earned, it's before income tax, but after the employer portion of self-employment tax, and the employer portion is 50%. For most people, 50% is about 7 to 8% of total taxable income. You can easily get the self-employment tax amount on many financial websites. My favorite is Motley Fool. Next, 25% is the maximum, but of course you can contribute zero of pre-tax income in some years. For those of you who are doing the math, you will notice that in the year 2020, $285,000 times 25% is $71,250. How could that be if the limit is up to 25% of pre-tax income with a maximum of $57,000? The two don't actually go together. It's because almost nothing is straightforward in the tax code. To get to the amount you pay on taxes, and assuming you maxed out at 25%, you divide $285,000 by 1 plus 25%, or $285,000 divided by 1.25. This gets you to $228,000. 25% of that amount is $57,000, and that's the amount that is tax deferred. So for someone who has pre-tax income of $285,000, they pay taxes on $228,000 today and pay taxes on the SEP IRA contribution of $57,000 upon withdrawal in the future. If you had made $185,000 after the 50% of self-employment tax and again contributed 25%, your taxable income would be $148,000. That's $185,000 divided by 1.25. So $148,000 is taxable now, and a contribution of $148,000 times 25%, which is $37,000, is taxable upon withdrawal. Last but not least, if you made $185,000 after your 50% self-employment tax and contributed 10%, your taxable income would be $168,182. $185,000 divided by 1.10 equals 168,182. Taxable now, and a contribution of $168,182 times 10% equals $16,818, which is taxable upon withdrawal. That's how you get to a total of $185,000. Finally, as promised, I'm going to take you through IRS Form 5305-SEP right now. The first line on 5305-SEP is just the name of your company. Let's just say that your company's name is Acme Printing. Article 1 for 5305 asks you for the minimum age of your employees. Now, the IRS won't let you defer this employee match for someone who's 21 years or older, but you can always improve upon that. So if you have an employee who's, say, 19 or 20, you can start the plan for those ages 20 or older. It requires you to pay earlier and more in many cases, but if you want to be more generous as an employer, you can certainly do that. And the other factor is an employee who's been with you for at least a maximum of 3 of the last 5 years. You can make it less, but if they've been with you for 3 of the last 5 years, that is the maximum duration that you can wait before you allow someone to join the plan. But let's just say instead of 3 years, you wanted to be nice and you wanted to give it to employees who've been with you for a year or longer. The third point is if you have employees that are covered under a collective bargaining agreement, then you don't have to include them in this plan. So it simply asks you, do you want to include employees that have a collective bargaining agreement for their retirement or not? And so here, let's just say that you don't want to do that. And the last point is if you want non-resident aliens to be recipients of the plan or qualify for the plan. And let's just say the answer is that it does include non-resident aliens. Also, if you want to include employees that make less than $450 a year, then you choose this here. If not, then you choose this right here. And then you, of course, put your name and title. Here. Now, what does each one of these choices do? The IRS tells you the maximum duration that you can wait before giving employees benefits for this. So it allows you to do some things that defer your payment into an employee's pension plan. Ladies and gentlemen, that's all there is to it. If you have additional questions, make sure you ask them in the comment section below and give the video a thumbs up so that others can find it as well. Also, if you'd like to see more of me and the videos that I publish on tax and business, make sure you hit subscribe below and click notifications so that you get notified the next time I publish a video. Also, one of the more popular videos that folks watch after watching a video like this is a video on the Social Security wage base. Make sure you click this video right here if you want to learn more about how the Social Security wage base works. This is Jeff Schmidt. Thanks for watching.